The markets as they are set up right now, should we be at record highs and are record highs to come?
Yeah, I think the market, I've been saying for a while, for the next 6 to 12 months is going to head higher for four main reasons: technicals, fundamentals, interest rates, and sentiment. Of course, we're going to have our normal pullbacks and corrections along the way, but as long as the big institutions continue to support this market, as long as the Fed is giving us a interest rate friendly environment, I would stick with the trend until things change.
All right, so the Fed is a big part of that story, Mark, but the Fed is always going to be part of it. Earnings are also going to be a driver of this as well. This earnings season has shaped up more tepid than previous ones. Is that slowing earnings momentum a cause for worry for you and your clients, Mark?
I mean, actually, earnings season's so far so good. I mean, everything's been better than feared. So we're seeing lots of companies right now beating and raising. Analysts were actually expecting an earnings contraction, but we're seeing year-over-year growth of around 3%. So, I mean, in order for us to really extend this bull market, we need earnings to contribute. I mean, all of the gains since Christmas Eve are from multiple expansion, and quite frankly, I'm not sure how much more multiples can actually carry the load. We need earnings to step up. My concern is that Q4 earnings expectations are still at 10%. So that seems really high given trade tensions. So I'd expect those to come down, which will put downward pressure on stocks throughout the rest of the year. And then analysts are expecting 10% growth in 2020, which I think is a little overly optimistic.
So Mark brings up a good point, Joe.
Yeah.
You mentioned that fundamentals are there, technicals are there, there's a whole interest rates are there.
Yeah.
What exactly set up, technically speaking, is constructive for the markets? Because we seem to be slowing out. These record highs, yeah, they're there, but we're not climbing at the trajectory that we were over the course of the past, say, 2 to 3 years.
Yeah, I mean, the big thing technically is that the big institutions control the markets. So people can come up with whatever macro theories they want, but at the end of the day, it's the big pension funds, mutual funds, hedge funds that are buying and selling millions and millions of shares that control the markets. And so far this year, we've seen very, very little selling from the big institutions, telling me that at logical and normal support levels, they continue to support this market. Now, Mark is right that maybe we might see heading into August, September, two of the traditionally slower months, we might see a little bit of pullback or digestion in the markets. But overall, while they continue to support the market, why would you argue when they're the ones who control it to begin with?
So what would, Mark, cause some kind of a selling behavior or a herd mentality to the downside? What needs to happen for these big institutions who manage money, by the way, for small investors like me? What would it take for that market to kind of move lower and for them to get that selling pressure going?
What would it take for the market to move lower? I would say, as earnings expectations begin to come down, that's going to exert downward pressure on stocks. I mean, you really have three forces that are moving the market right now. You've got the Fed. It seems like the Fed's going to cut next week, right? They're pricing in 4 cuts over the course of the next year, so that's a positive. Trade, we still don't have a trade deal, so that's a headwind. And then as far as earnings go, yes, this earnings season's been pretty good so far. However, we are concerned that expectations over the course of the next several quarters are just a little bit too high. However, over the last 60 years, investors would have done extremely well had they owned stocks when monetary policy was easy and avoided them when policy was tight. So annual returns on the S&P 500, excluding dividends, while policy is easy, which is where we'll be after the cut next week, 9.7%. Annual returns excluding dividends while policy is tight, only 0.9%. So it is important to stay invested. You have to stay in U.S. equities. There's no better place right now.
All right, we've just got about 20 seconds, 30 seconds left here. What are the places in the market that you look at as leading indicators for the next leg?
For the next leg, technology is still strong, as well as, one last point I want to make about what Mark said, earnings and interest rates control the markets. The key will be the statement in the upcoming meeting next week, because if they cut and give a hint that they're going to continue to cut, that will be good for the market. If they say one and done, we might be in a consolidation period over the summer.